Welcome to How Do They Afford That, the podcast that peeks into the financial lives of everyday Australians. I'm Michael Thompson. I'm a writer and co-host of the Fear and Greed Business Podcast. And as always, I'm with Canna Campbell, financial planner, founder of Sugar Mama TV, the financial literacy platform covering YouTube, podcasts, obviously like this one, books, Instagram, pretty much everywhere where you can consume content, you will find Canna and Sugar Mama TV. Canna, I need to ask you about, hello, by the way.
Hi.
I need to ask you about Manifesting March because Manifesting March was some time ago now. And I understand that it would be, take a little while to kind of add up everything, kind of
all the money I made.
Tally all the money that you have manifested. And
counting away.
I still have that image of, you know, the visor with like the kind of like the see-through visor and the pen behind your ear and the calculator with the thing that goes.
See, I would go with more of a Scrooge McDuck, you know, where he's jumping into his safe is so big in his house, he jumps, he does a dive into all the cash and he's doing like backstroke.
And is that
with all the coins and notes flying around him.
Is that what you manifested?
I had an incredible Manifesting March experience. I haven't actually shared the final number and what actually happened, but it is my biggest and most successful year yet. And I even managed to manifest an interview with Gabby Bernstein, who is Oprah's go-to person for manifestation.
She's a manifesting
and spiritual growth
guru, isn't
she?
Yes,
she is. She's huge. She's big in the US. She's actually coming to Australia shortly. And I had someone when I was doing her 21-day challenge at the beginning of the year, which was quite a life-changing experience for me. Someone DM'd me on Instagram and said, I have a feeling you're going to interview Gabby Bernstein. I was like, oh, yeah, that would be cool. And then someone else messaged me again a month later to say, you need to manifest an interview with Gabby Bernstein. Lo and behold, it happened. And Gabby Bernstein has 1.4 million followers just on Instagram. She's got multiple New York Times best-selling books. She's basically up there with Anthony Robbins as gurus. And yeah, I interviewed her. How ironic is this on the last day of March?
So that's a very physical kind of, and I should actually just say that if you're not sure what we're talking about in terms of manifesting and Manifesting March and the purpose of it all, that we did a full episode on it about 6 weeks ago now, where you kind of convinced me in the power of manifesting and the fact that you can kind of encourage the flow of money into your life.
I believe I said, open yourself up to the flow of money.
I think I kind of forgot to do it in the end. I don't think I actively closed myself off to money, but I didn't see a huge amount flowing in during March.
We'll have to work on that. I think we just need to make a few changes in your manifestation exercises, perhaps. But you know what? I had a lot of people DM me on Instagram about their successes. I had a woman who manifested a new car. I had a woman who manifested $15,000. Another woman manifested winning a competition and she won all this stuff plus $5,000 cash. Someone manifested an inheritance.
Okay, so manifesting the new car could just be a case of thinking, I really want a new car, and then she goes out and buys one.
No, she actually said, I'm going to screenshot the DM she sent me because it was quite incredible. She was listening to our podcast. She sent me this message and it went along the lines of this. Hi, Canna, I just discovered your podcast on How Do You Afford That? Really great, loving it. Listen to the first podcast, which was Manifesting March. I've never done any manifesting work before, so I thought, why not give it a go? I want to manifest a new car. And she wrote, I kid you not, within 5 minutes of saying out loud, I want to manifest a new car, her car breaks down, completely dies, has to be towed away, gets home. The next day, her husband calls her from work and says, you wouldn't believe this. I've just been offered this incredible new job. Out of the blue, unexpected, great pay rise. And she said to him, does it include a new car by any chance? And he said, you know what, let me make another phone call. Calls her back, new car package included. So she said she's driving a brand new car and she got the other car. It was $1,800 to get it fixed. And she said, I'm just going to keep it for emergencies just in case we can now have 2 cars because we really need it as a family. But how about that? And she said, thank you for teaching me about manifestation. I think I've done my dash for the year. I will stop at that.
That is pretty impressive. The other one, though, that kind of raised a few red flags for me there was the person who manifested an inheritance. It feels like something that maybe the police should be aware of. There may be something sinister because it feels like something that you could not just manifest, you could in fact manufacture with a little bit of help.
Murder, yeah.
Yeah. So, look, question marks over that one, but I'm glad to hear that Manifesting March was a success.
It was.
Not just for you, but for people that you have inspired to manifest.
And it is a bit about a movement, really looking at, I guess the abundance and looking at limitless opportunities that really do surround all of us, opportunities to save money, opportunities to earn extra money. And you know what? I think 2023, for everyone who's struggling right now and feeling the pinch, which I'll put my hand up as well, it's all about having a bit of a hustle. So if your hustle is a manifesting hustle, so be it if it works.
Yeah. No, look, okay, we could talk about manifesting, I suspect, for the entire episode, just because you can tell I'm still like a little bit skeptical, but broadly open. But that is not what we're here to talk about today. We've talked a lot in previous episodes about investing. Obviously, we talk a lot about investing, everything from kind of amping up your super to kind of building a property portfolio. Today, I wanted to kind of talk to you about two key methods, I suppose, or kind of schools of thought. Approaches, that's a good way to put it, to investing, passive investing and active investing. But before we do that, it is very, very important to know that as you're listening, anything that we talk about is always general in nature. It is never personal, investment, strategic, or product advice. It is purely for financial education purposes only.
That's right. Anything you listen to and you think, oh, is that right for me? Please go and get personal advice from a financial planner based on your current situation, your goals, your dreams, your risk profile, and your deadlines, particularly as you listen to this episode.
Passive and active investing. I think we'll have to kind of start at the very beginning for this. Yes. Are we talking about shares here mostly?
Yes, but not always. It can be ETFs, it can be managed funds, it can even be property, like people who flip property, buy property, do it up, and then quickly on-sell it. So it doesn't necessarily need to be just equities.
Okay, so flipping property, that's actually a really kind of tangible example of something that is that's active. That's a very active involvement and engagement in your investment. Okay, so broadly speaking, the difference between the two. Go.
So passive income is more about a long-term buy and hold strategy with a preference to build the long-term growing passive income stream behind the investment, which is quite often dividends. And as I said, it's a long-term strategy really focusing on compounding growth. And these types of investors who prefer this passive strategy reach for ETFs and typically index funds. And they can be more tax effective as you're only paying income tax on the dividends that you earn rather than having to constantly pay capital gains tax when you sell. But I will say that passive income investing is a very relaxed, easygoing strategy and quite cost effective. And it often goes hand in hand with that set and forget investing strategy that we talked about in our previous episode.
Before you get onto passive and before you kind of compare, I just want to check ETFs and index funds. ETFs we've talked about before, exchange traded funds. Index funds. A definition, please.
Well, you're essentially buying the market. So if you're buying, the ASX index, you're buying the top, depending on the actual fund and the fund manager, you might be buying the top 50 stocks in that market or the top 100 or the top 200 in that market. You're essentially buying the market as it is, as a package.
Okay, so it's a fund then that would essentially kind of track the overall performance of either not necessarily the whole market, but a fairly substantial chunk. And if it is, say, the top 50 or top 100 or top 200, that is where the bulk of the movement comes from anyway.
Exactly. And look, ETFs and index funds quite often can be very similar, but obviously there's more and more ETFs that are springing on the market every day. So you do need to read the PDS behind each product.
Okay. So the kind of the polar opposite then would be active investing. And even the name kind of says that it's going to require a lot more involvement.
Yes, lots of time, lots of energy, lots of big decisions. So
you're not selling it very well for me here. I'm a very inactive kind of. I don't want to say lazy person, but this feels like it requires a lot.
I will be honest with you. I have a preference towards passive income investing, and there have been a lot of studies that show over the long run, passive strategies can be more financially beneficial in the long run. But active investing is, as I say, it's a lot more proactive, a lot more hands-on. And you're really focusing in the short term and focusing on profits. So gains are made by quickly buying and then selling and trying to beat the average market returns and making a quick dollar off the back of the natural market volatility or what might be going on in the economy or in that particular industry. But you do pay capital gains tax when you make a profit.
Okay, there's a few things I want to ask you about when we were talking about passive investing, and you mentioned the set and forget. It feels like this is the kind of model whereby you can kind of keep contributing to it relatively easily over time. So when you're kind of building up your $1,000, you're doing that through kind of your side hustles or selling things on marketplace or kind of doing little extra jobs for cash on the side, that kind of thing.
A regular investment plan.
Yeah. And so you are aiming to kind of say build up to $1,000 and then you're able to kind of contribute it into this fund. You're actually able to kind of keep adding to it.
Absolutely. You can continue on accumulating more, add more to the portfolio, and obviously reinvesting the income, which is the dividends, back for further compounding growth opportunities, helps that portfolio grow even further and build your financial wealth.
Okay. There's something about active investing that kind of screams risk to me. And look, I know saying that, I know that all investing comes with risk, obviously. But is the risk higher than with active investing because it is not set and forget, because you are intervening more, you're kind of making more decisions along the way, means there's potentially a higher risk of making mistakes and actually making some bad decisions along the way. And look, if it sounds like I'm speaking from experience, it is because I am, and that I have attempted this strategy in the past. And my kind of ratio of good decisions to bad decisions would probably be about 4-1, as in 4 bad decisions for every 1 good decision that I made. So I have been burnt.
Well, look, I actually have some statistics to share with you in a second that will make you feel a little less embarrassed, perhaps.
Hang on, who said I was embarrassed? Are you saying I should be embarrassed?
Well, you got to think, I mean, people who try and do this themselves, they're putting a lot of stress and pressure on themselves. Even fund managers with years upon years of experience and amazing access to information and data, and you can almost call the CEO of a company if they want. Yeah. They still get it wrong. Yeah. So to try and put pressure and stressing yourself to be an active fund manager trading from home is, you got to dream. And I'm not even going to get anyone's way, but we also need to be realistic. But to answer your question, before I go down another path.
The worst part is I just assumed I was going to be great at it. I'm like, I can pick trends. I can see what this company's going to do. Then it did the exact opposite. And now, 5 or 6 years later, I'm still just praying that it makes a comeback.
Well, we need to do a podcast episode on diversification, and that's another topic for another time. But to answer your question, with active investing, yes, there are a lot more risks involved because there are a lot more variables. You've got to think about the time to buy that investment, the time to get out of that investment, the market volatility, the economic climate, even the political environment. And these multiple variables can work for you or against you. So it really boils down to experience, knowledge, and the investment goal behind the strategy. Is it to make 10% profit, or is it to make 20% profit, or is it just to make enough profit we collect a dividend and quickly sell? There's multiple different strategies. And this is why these guys are called fund managers, and they go to university and they get all these amazing MBAs and so forth to have lots of wonderful acronyms at the end of their name to then, go on and make millions of dollars for their employer. So it does, to answer your question, active investing does tend to lean itself towards more risk.
It seems like then it would rely on a huge amount of research, potentially. No, not just potentially, definitely. You would need to be doing a lot of research if you were to be doing this.
That is correct. And there is a reason why active fund managers tend to charge more in their ongoing fees.
Oh, right.
Because you think about it, they've got a lot more risk. Yeah. They've got potentially more staff. They've got to access more information. They've got to maybe use more complicated software programs. There's a lot more work involved, therefore their fee is higher. And also, because they're jumping in and out of stocks, making quick decisions, they're charging brokerage all the time. So their total brokerage cost to run the portfolio also comes out of the profits. So there's a lot more skin in the game with active investing. And I'm not for or against, even though I personally prefer a passive strategy for my investing goals, which isn't obviously personal advice. I'm just sharing that with you. But it is important that everyone understands the difference between active investing and passive investing, because they're not necessarily right for everyone. And you can actually have a blend of the two.
Yeah, and I think actually I was kind of stuck on this thought that if you were an active investor, you were essentially doing it yourself, that you were kind of trying to pick your own stocks and you were essentially trying to manage it yourself. But no, you made the point there that you can use essentially a broker or someone who is actually managing your fund for you, but they are an active investor. So the fees are going to be higher. But on the plus side, you get the benefit of their knowledge, their experience, rather than you having to research and try and make these decisions. That's like correct. I made myself.
You can delegate all your financial decisions, or all your investing decisions to a stockbroker or to a fund manager.
Who then is active investing kind of best suited to? You mentioned there that one of the decisions that you need to make in this is what your goal is for your investment. Is there a particular type of person that would be better suited to, say, active investing or a particular stage of life? Does it come down to your risk, your appetite for risk?
It comes down to lots of things. It comes down to the benefit of time. So someone particularly younger in life that can afford to take those risks, they've got the benefit of time, that would be ideal. Someone who also has a high growth or growth risk profile. So if you haven't listened to our podcast episode on risk profile, make sure you go and listen to that so you know where to quickly and easily find out your risk profile. Someone who's also got a good cash flow, because if you've got money tied up in the market and the investment decision you've made has worked against you, but you don't want to sell because you'll crystallize your loss, but you want to keep that market in the market to help it maybe recover or give it some time or maybe even receive a dividend to help ease the pain, you need to have your own surplus cash flow to rely on, so you don't have to be forced in a position where you have to take that money out and crystallize that loss. Obviously, having great liquidity is another big consideration, particularly people who are trying to trade penny stocks. Where those people who, it's often mining companies where, they hear about a company that's about to strike gold and, the stock is trading at 7 cents and it suddenly bounces, say, to 12 cents. If there's no market being made, there's no liquidity, that's great that they may have come close to doubling their money, but there's no one to actually buy their stock from at 12 cents. So that's a big consideration that people forget about. And also emergency money. The type of people that do this type of active investing have to have plenty of emergency money to fall back on. So if something happens out of the blue, they're not forced to go and sell their investments down. So, and look, that's not limited to everything. There's obviously more things to consider. That in a nutshell are the type of people that it's benefited.
All right. We'll come back in a second. I want to talk to you more about kind of passive investing, some of the benefits of it, but also some of the downsides. And also I want to hear whether there are some horror stories, because I want to feel better about my own horror story about where kind of active investing has gone horribly wrong for people. And we can all, maybe it'll make us all feel a little bit better about ourselves, like me. Hannah, we're talking about passive versus active investing, obviously two kind of fairly significant approaches to investing. And as we've learned, they are very, very different in their approach. And you mentioned earlier that it's not just about equities, that there can be other kind of forms of it as well. And I'll come to that in a moment. But I wanted to know first, when we are talking about shares and people being active investors, have you seen it go horribly wrong? And I shouldn't ask you this with a smile on my face because it's going to make me sound a little bit sinister. Hang on, I'll try it again with a frown. Have you seen it go horribly wrong? I can't do it. I'm
smiling back.
I'm a naturally happy person, and I want to smile while I'm talking about others' misfortune. Please go on.
Oh my gosh, absolutely. I've seen it go tragically wrong, and I've seen people put all their eggs in one basket and literally wipe out all their money.
Really?
On a speculative investment. They didn't understand what they were getting to, didn't understand how much risk they were taking on board, and it's heartbreaking, and they've had to start all over again from scratch.
Assuming these people probably weren't getting professional advice.
No, they weren't. And the thing is, with this type of investing, I have clients who like to dabble in a little bit of speckies, and that's fine. But we'd say, look, you've got this amazing portfolio. Why don't you play around with, say, 5% of that portfolio, and we'll keep 95% or 90% even in the stuff that's really aligned to what your financial goals are, which is building long-term growing passive income streams and building financial independence and freedom. So they would have that money to go and play with. And I would say 9 times out of 10, that client would come back to me with their tail between their legs going, okay, didn't quite go to plan. Can I give you back what I have left?
Oh, no.
And we'll stick to your strategy. And look, that's not to blow smoke up my own backside, but, the home trading is very, very risky. And I read yesterday on the website Invez, with a double Z, only 3 to 5% of home traders actually make any money, which is really interesting. So, and
Really?
I know a couple of successful home traders, but they have actually been fund managers for like 20, 30 years.
Oh, well, that doesn't count.
And so they're technically home traders because they no longer work for their employer, but
no.
they're the ones that probably fall into the 3 to 5%. So, and the other thing I'd like to point out is what they realized is when they made a gain, that was great. They also had to pay capital gains tax. And all of these times where they did make a gain, they sold within 12 months. So the full profit was taxable. Whereas if they'd waited, and this is not in strategic advice, but if they had known that and been aware of that, they could have potentially waited until 12 months and got a 50% capital gains tax. So people who are using active trading really need to be aware of the fact that those gains are taxable and they will be fully taxed. If they have held that investment for less than 12 months, no CGT discount, which really does eat into your profits. If you're on the top marginal tax rate and you've made, say, 12% profit, it really comes down to 6.5 when you take out the tax and you take out your costs as well.
That is a huge difference.
Yeah, it makes you really think, is it really worth it?
Yeah.
And now I'm sounding cynical. You think about the time it takes you got sitting in front of a computer screen. You hear information, you might need to make a quick, sudden decision. Now, are you near a phone to log on and make that trade and make that decision? Or do you have to make a phone call to your broker? Or do you need to analyze some software? Do you have access to a computer or a laptop screen? There's lots of different things. So you really need to think is the time worth it? Is the capital gains tax worth it? And are the fees eating into my profit line each year worth it as well? So there's lots and lots of things to be considered. And again, that's probably why I prefer a passive strategy.
You see that in the last couple of years, there's been a huge boom in people investing for the first time. There was a lot of, particularly during, I think it was in 2020, during the first year of COVID, there was a sharp spike in the number of people that were getting involved in, there's so many apps and everything now. And obviously all the banks have kind of share trading platforms attached to them, but then a lot of kind of dedicated ones that are just for trading shares on. And I think they've all seen kind of spikes from 2020, 2021. So you can see that there would have been a lot of people kind of dabbling for the first time. And unless they were using those apps to buy, say, ETFs potentially or index funds.
Diversified investments.
Yeah, indeed. Then chances are they would have fallen potentially into this category of essentially being active investors by trying to pick a winner.
And this is where it really lends itself to the word or the warnings of gamblers. If you don't really know what you're doing, you essentially may as well go to the casino and put your money on red or black. I mean, you're making uneducated decisions, huge amounts of risk, and huge amounts of risk that you don't actually not even aware that you're doing. And the thing with gamblers, particularly people who have a gambling problem, is you only ever hear about the winners. They'll tell you about how they won this much money on the pokies or at the casino. They very coy about the time they lost all their money or came close to being bankrupt. So you really have to be careful. Now, if I was to take $100,000 and I was looking to invest that for the long run, I wanted a passive approach, looking at something like an ETF or an index fund that matched my risk profile might be a more intelligent use of my time after getting professional advice, of course, because some of the ETFs out there have fees as little as 0.03% per annum. So on my $100,000 that I'm going to invest in a diversified investment portfolio, if I picked one that has a fee as low as that, and that one is obviously on the lower end of the scale, that's $30 a year I'm paying that fund manager. I would rather spend someone $30 a year and have all my time back and also release all that pressure and stress of knowing not only what to buy, but when to buy and how much to buy.
All right. On that, though, are there downsides to passive investing? Can you miss opportunities that way? Because if you see that the market is potentially turning, which is always a gamble, kind of trying to time the market is, and listen to any kind of professional trader, and they'll say that it's not kind of timing the market, it's time in the market. But can you miss kind of opportunities if you take a passive approach?
Of course you can, absolutely. And there are people out there, particularly as we see, you talk about all these new apps of being able to trade, and there's a lot of millennials jumping on board, really getting on, part of this and part of the FIRE movement is sometimes passive income investing or passive investing is very slow and boring. And it can get frustrating. People want to tweak and play with their portfolio. And there can be an issue where part of your portfolio is overvalued. So, for example, a fund manager has bought a particular stock that's done very well, and it now takes up, say, 70% of the portfolio. That is adding risk to the portfolio because your returns are very much reliant upon that one large stock in your overall portfolio. So returns can be disappointing as well. And look, over the long run, whilst passive investment strategies can exceed the returns of active strategies because you've got to take out the costs and in particular tax there, you may not necessarily beat the market as such. So you may not be as ecstatic with your returns when you look at individual stocks. And I've taken a really long way to explain this.
No, it's the kind of thing. So you're not going to go to the pub and brag to your mates about how you kind of picked the next Afterpay kind of thing, but you might actually be able to go home and just be comfortable with the fact that you've kind of made good long-term decisions potentially.
Exactly. So you're not coming home with the champagne under your arm saying, we've just doubled our money over a night. It doesn't lend itself to that outcome. It's more slow and steady wins the race, like the tortoise and the hare story. But it is important to point out when you take this passive approach, you are receiving all the beautiful dividends that come with this strategy that also help increase the return. So whilst you may have a capital growth component of your portfolio, never forget the money it's paying for you back through those dividends, which are very powerful and you can use to spend them or you can reinvest them for future compounding growth opportunities.
But do not forget that they are taxable.
They are taxable, but you know what? Depending on where you've invested, there may be some franking credits attached to those which come with tax benefits.
Which is why it is great to get some professional advice because they can take you through all of those potential benefits.
And why you need to be subscribed to our channel because we will do a podcast on sexy franking credits.
Sexy franking credits.
Yeah. I think I need to know fabulous franking credits. I love my alliteration.
I don't know. Sexy franking credits kind of sets a very high bar. You really have to deliver there.
Well, one of my clients got a franking credit tax refund of $70,000. So is that sexy or not?
Okay, that is somewhat erotic.
Particularly for retirees, those franking credits are really, really valuable.
So now we're getting into sexy retirees. Is that what you're talking about?
Oh, yeah. We should do it. We should maybe shift our recording to maybe some sort of aged care centre perhaps. And
this feels like we're getting into really kind of dangerous kind of territory and do it after dark. Goodness me. How do they afford that uncut? We've covered a bit. I wanted to talk to you more about the active side of property. But I think it's actually fairly self-explanatory because it kind of goes from what you said with flipping property, which is so hands-on. You're involved in every kind of aspect of it, as opposed to making an investment decision about property and essentially stepping back and either letting someone else manage it or just letting it grow.
Well, you can also use something like a property trust as well if you want to take a passive approach to property.
Mm-hmm.
There are lots of property trusts that you can buy shares in on the ASX. Obviously, this is not advice.
No, that's good, but it's something I hadn't thought of.
It's an example because a lot of Australians tend to think property, residential. There's commercial property, there's industrial property, there's rural property. There are lots of different things out there when it comes to property, and that's how you can use something like a property trust or even a property-based ETF even to access those type of investments so that they're diversified and you take that slow and steady long-term approach where you sit back, relax, just collect the dividends.
It feels like there is the potential for an episode in that.
That is why everyone needs to be subscribed.
Yes, indeed. Now, we have covered a lot. I mean, clearly we spent most of our time talking about equities because that is where the focus really is for this. And so passive investing clearly is more of a long-term kind of buy and hold approach where you might look at things like index funds or ETFs that essentially kind of track the performance of the market or of a particular section of the market rather than, say, active investing, which may involve either you individually picking out stocks that you think are potentially going to be winners or using an active fund manager who is doing it on your behalf, but still taking that kind of same approach. The other thing to be wary of, or to be aware of with an active approach, is that it requires a lot of research. It requires knowledge. It's likely to require a lot more time as well. Whereas passive has the potential for you to take almost a set and forget approach, where you're able to do this as potentially a long-term strategy, where you're able to contribute to it over time and hopefully watch it grow over a long period of time. But of course, there are risks and there are downsides to every kind of form of investing. I mentioned the active investing downsides being that you are taking a chance a lot of the time. And if you are not an expert, then it can become pretty much akin to gambling. If you make the wrong decisions, it can be more expensive, particularly if you're using a fund manager for that. Some of the downsides, though, to passive investing are that it may be too slow for you. The returns may not quite be as exciting as what you might see some people achieving with an active approach, but that you need to get some professional advice and decide what approach suits you for your goals, your financial goals, for your stage of life. Yep, indeed. And your deadlines. And the key to all of that is to get some professional advice. I reckon I have said the words professional advice at least a dozen times this episode.
Well, can I just chime in one last thing? I know I'm very naughty going over time, but even though fund managers find the subject of active versus passive quite polarizing, they tend to prescribe to one or the other. As an investor, you have choice and control. And you can say, well, look, I like this strategy of passive that suits my risk profile and my goals, but I'd also maybe like to have maybe 20% of my portfolio with an active fund manager or taking an active strategy. So you can, in fact, have the best of both worlds if that's what's appropriate for you.
The highlight of this episode for me was when you alluded to blowing smoke up your own backside, which I don't know. I'm assuming it requires a lot of flexibility.
Well, I don't do yoga, let's just say.
All right. Well, Canna, if anybody wants more information, not about blowing smoke up anywhere, but about this topic, where can they find you?
Well, I have my own podcast, Sugar Mama's Fire Play, which is published every Monday morning at 5 a.m. You get double the financial motivation, inspiration, and education from myself and Michael. And then, of course, Instagram is probably the best way to get in contact with me. If you shoot me through a DM, it's not staff that you get hold of, it's actually me. So make sure you're following me there. And that's where I provide you with all the immediate access links to both podcasts the moment they go live.
And you can hear me every day with Sean Aylmer on Fear and Greed, Australia's most popular business news podcast. And you can also find my novel, How to Be Remembered. I almost forgot the title, because How to Be Remembered is very similar to How Do They Afford That, which is the name of this podcast. But How to Be Remembered is the name of the book. It is available right now wherever you buy books. Next week, we are going to be talking about food, one of my favorite topics, but it is an area that is really kind of biting for a lot of people. The household budgets are being hit hard, and particularly when you go to the supermarket. So we're going to look at saving money on food. In the meantime, remember to hit follow on the podcast. Leave us a review too. Join us next week for that chat about food. Don't miss it.